Welcome to Business Buffet, the Help Yourself video series, bringing you fast food for thought. Info you can really sink your teeth into. For best results, first review the program without doing the exercises, and ask yourself the questions in the notebook introduction. Then, zero in on each section, doing the exercises as you go. Here are some of the characters you'll be meeting. You with a business idea. Your competitor with a different idea. Your product or service, your supplier, your prospect, and your customer. When you hear this and see this, it's your signal that there's something to do. Have the notebook handy and jot down the ideas you get. After reviewing the whole series, your notes will be a valuable resource. As you plan and grow your business, watching again and again will stimulate fresh insights and creative solutions. And by inviting others to watch with you as a basis for discussion and brainstorming, you can benefit from their ideas too. Now, let's take the fear out of finance. Welcome to Financial Forecast. By the end of this program, you'll be able to explain the purpose of financial forecasting, define the components of the key financial statements, and develop a sample forecast. Imagine if you had a crystal ball. You could predict business trends, interest rates, market changes. You could make risk-free decisions, assuring the most productive and profitable use of all resources. You'd know what's coming, so you'd know how to prepare. But without a crystal ball, or at least a plan, you have to rely on past results. Too late to make a change if you're off course. It's critical to set your sights on your personal and business goals and map out a plan so you have the right resources available when they're needed. So your survival depends on how well you can predict the future. Financial forecasting is a way to simulate your own crystal ball. Your financial forecast answers 3 questions. What financial position will the business be in at the end of this fiscal year? What resources will I need to take it there? And what financial commitments will I have to make along the way? Combined with your experience and industry realities, the what-ifs of financial forecasting force you to think through growth opportunities, assess their feasibility, and plan the resources you'll need. And they help you clarify and quantify your anticipated financial needs so you can control expenditures before they happen. They also provide a benchmark so you can compare your plans with actual results. Picture your forecast as a roadmap of a 12-month trip. If you're well prepared, you can confidently forge ahead without stopping too often for directions. You may make twists and turns and even get lost once or twice, but your sense for the general direction will keep you on track. Time is money, so let's get started. What do you want to do next year? Increase sales gradually, within your comfort zone, so your business stays a manageable size? Or grow explosively to the point where you can sell it to a larger organization? Do you want to be the hands-on decision maker? Or do you want to hand the company over to a management team so you can get on with another startup? It's vital that you decide where you want to be in terms of finances, operations, sales, and people over the next 12 months so you can plan strategically how to get from here to there. Your company can be the vehicle that delivers dreams for you and your family. So the exercise should start with your personal success needs. Where do you see yourself? Focus on your personal financial position and how you want it to change. Then prepare a few strategies to get yourself there. If everything goes your way, what will your business look like? Write down your personal goals for your business and your family. Pause while you write, then press play to continue. The video, How to Read a Financial Statement, explains the interaction between the operating statement and the balance sheet, the key financial statements that help you see how you're doing. Now, we're going to do a pro forma, or predicted operating statement, balance sheet, and capital plan to show where you're going. If you're already in business, you can analyze your track record and combine it with industry indicators. But if you're just starting out, you're charting new territory with no history to draw on. Say you make doggy treats. Your industry association can help you gauge typical costs and revenues, so you can compare them to your track record. If you're introducing a new concept, doggy drinks, you can still rely on the established doggy treat industry for some indications of what to expect. In the absence of a crystal ball, base your forecasts on your goals, the marketing research you've done, and what's happening in your industry, and keep a record of the assumptions you used. Since you can't be sure what will happen tomorrow, develop a few forecasts based on different market strategies: best markup, lower markup, and discount. Of course, in your first year, it's especially important to bring in enough revenues to cover your expenses, or at least to plan the finances to help you through this period. Forecasting helps clarify your options. Fixed expenses are relatively easy to predict. Things like telephone, rent, insurance, light, and power don't change with sales volume, so start your forecast by listing fixed expenses. Now think about the costs associated with what you sell, like material, processes, and labor, and document them under cost of goods sold. As your business grows, you may need help. Your people plan should include who, when, and why. Don't forget to allow for holidays, sick time, a reasonable hourly wage expense, and overtime at peak periods. Industry norms can guide you. Plan your promotional activities and estimate their costs. How much money do your competitors invest in promotion related to their revenues? If you're shooting for a higher market share than they have, you should probably invest more than they do and set aside extra for contingencies. Your appearance on the scene may stimulate response from your market, but it can also be the spark that ignites your competition. You need to be able to hang in for the long haul, so be prepared to fight for your share. What are your plans for the next year? Pause while you draft your operating forecast, then press play to continue. Physical assets like equipment, vehicles, and furniture often incur financing and interest expenses, so your forecast must include a capital plan of anticipated purchase and disposal of assets. First, decide what assets you'll need to grow your dream machine. Then schedule the money to support your plan, month by month. If you can't see how a planned purchase will deliver new profit, do you really need it? List the capital equipment you're planning to acquire or dispose of, and where you'll get or invest the money. Pause while you write, then press play to continue. If everything works according to plan, what will you own? What will you owe? Drawing on your forecasts, you can now check your year-end score with a pro forma balance sheet. How much money did you say you'd bring in? How much inventory will you still have on hand? These are current assets. Then list your fixed assets, their opening balance, and the depreciation expense you're planning for the period. Don't forget the acquisitions and disposals proposed in your capital plan. Balance these against the money you'll owe, bank overdrafts, loan payments, and set-asides for taxes. And of course, owner's equity and retained earnings, the one nearest your heart, the money belonging to you. Create a year-end pro forma balance sheet. Pause while you write, then press play to continue. How much do you have to sell before you show a profit? Break-even is the point where sales cover costs and expenses. If you were to sell your break-even amount to one customer, your business would be profitable from sale two. But if prices drop or expenses increase, how much more must you sell? And if you increase production capacity to handle these extra sales, you increase costs. How much then? Here's a formula you can use to calculate your break-even point. Fixed costs divided by the selling price minus variable costs. You can also use this formula to evaluate a major expenditure or see how many sales you need to increase your profit. Just add the objective to fixed costs and repeat the formula. Calculate the number of units you have to sell to break even. Pause while you write, then press play to continue. In some ways, financial forecasting is like shooting an arrow at a distant target, on the side of a barn. You won't hit the bullseye very often, but you won't miss the barn either. Now that you can explain the purpose of financial forecasting, define the components of the key financial statements, and develop a sample forecast, refer to your pro forma and compare your projections with your results. If you use your forecasting tools, you can improve your aim, sharpen your focus, and increase your chances for business success. And don't forget, consult your accountant or financial advisor as you implement your plans. This has been part of the Business Buffet Help Yourself video series. Business Buffet, helping small business help itself to profit by making business learning fun. If you enjoyed this overview, you'll want to know about the other exciting products and services specially created to help small business help itself to profit. For information on the growing list of Business Buffet products and services, and to be placed on our mailing list, contact Business Buffet and help yourself to profit. Thank you.